Hello, this is Will Allen with Sentara Capital. As we get close to the midway point of 2020, we're going to take a look at recent developments surrounding the coronavirus, as well as look at the continuing rally in the U.S. stock market. And lastly, we're going to check in on the U.S. consumer. Let's dive in. Now that we have moved into June, we are seeing that most states in the U.S. have reopened to one degree or another. And one of the things that we've been closely watching are the states that reopened before May 1st. There were 13 states, including Georgia, that did that. And a lot of people had projected that we would see a real surge in cases, new cases, and deaths as a result of that. And what we know now, more than 4 weeks in to the reopening, is that in those 13 states, new cases are 11% lower today than they were late April. And that is despite the fact that we've seen a lot more testing. And you would think if there was a lot more testing, you'd have a lot more new cases, but that has not been how it has played out. Also, deaths are down 23% now versus when this group of states reopened. So that's a real positive that people are being pretty smart in these states, and that just because you reopen, it doesn't mean you're going to see for certain major surges in new cases and deaths. We also see similar data over in Europe. Many of the European countries are way down the road of reopening now. In fact, many of them, schools are back in session, small businesses are opened, and we've seen countries like France and Italy and Spain that were really hard hit by the virus. We've seen their cases and deaths plunge despite the fact they have reopened. This is a real good sign. Now, we don't know how much of this is due towards the warmer weather. There certainly is still going to be the case as winter approaches, late in 2020, that you could see another surge. But so far, I think things are about as good as we could ask for with regards to the reopening. The stock market has continued what has been an impressive rally off its March 23rd lows, and one of the recent developments that has been real positive is in the last 2 weeks we've seen banks, energy companies, industrial companies leading the rally. And this was something that we flagged in our last email update about 3 weeks ago. We pointed out that those groups had really underperformed, and it was technology, healthcare, utilities that had led the rally to that point. And tech stocks, for example, are companies that can grow in kind of any environment. What you want to see is the groups that are more dependent on economic growth to do well, like banks, energy, and industrials. You want to see them having strong moves to the upside. Now, it's only been 2 weeks, and a lot of these names are still down 30 or 40% from where they were in February, but it's an important development so far, and we hope it continues. In addition to that, we now have $5 trillion in money market funds in the U.S. The average over the last 10 years has been $2.5 trillion. What happened is when you had this major decline in March, you had a lot of investors panic and get out of stocks altogether or significantly reduce their equity holdings and moved into cash. Going forward, that's money that typically, when investors have missed a move higher, they come in on any pullback. And so a pullback may end up being more shallow than it otherwise would have been because you have that money coming in and buying. So you don't see what may have been a bigger decline take place. We'll keep an eye on it. The other thing, and take a look at this chart, this is U.S. investor sentiment. And this goes back almost 10 years here. And what you will see currently, 42% of investors are bearish. And if you take a look over the last 10 years, Between 42 and 50% bearish investors, when it's reached that level of pessimism, stocks have done very, very well in the upcoming 6 and 12 months. Think of this as a contrarian indicator. When a lot of investors really hate the market and are very concerned, stocks tend to do very, very well. When investors are giddy or euphoric about the market, stocks tend to really struggle. So we'll keep an eye on this, but this is a little bit surprising that even after this market rally, you still have 42% of investors very bearish. Again, this is a positive for market performance in the upcoming months. The most important factor in the economic growth we have seen in the last 10 years has been the strength of the U.S. consumer. There's been a lot of adversity come their way over these last 10 years at different times, but they've held up very, very well. That said, they haven't seen anything as challenging as the conditions that have come with the coronavirus. Right now, we have seen 40 million new unemployment claims over the last 8 weeks. Now, some of these people have already found new jobs, and it's also the case that over 75% of people that have applied for unemployment benefits have indicated that they believe that this is temporary, that they will have their old jobs to go back to in the not-so-distant future. We'll see. I think it's too early to know exactly how that's going to play out, but it's an interesting development. On the economic data side, new construction spending, searching for new homes, and purchasing of new automobiles all have recovered a lot faster than what analysts have predicted. You can see the charts here and see a nice increase in all those categories. And again, those are big ticket items for a U.S. consumer, and they normally aren't going to spend on those areas unless they feel pretty confident about their upcoming future. Another thing I want to point out is the CARES Act that passed a couple months ago extended unemployment benefits where the federal government is paying $600 a week in addition to the benefits that unemployed individuals get from the state. And why that matters is there is research that was just done that indicated that 2/3 of people receiving unemployment benefits are making more money now than they were at their jobs. In fact, 20% of those receiving unemployment benefits have at least double the amount of earnings they were at when they were at their job. So that's a lot of money getting into the hands of these individuals, in addition to the fact you had the stimulus checks of $1,200 a piece go out. And so I think that's helping consumer spending be stronger during this period than what a lot of people had thought. We'll see. Right now, the unemployment benefits, the $600 a week is expected to run out and end in late July, though it's very possible that could be extended with another stimulus bill that the Republicans and Democrats are working on. But as it stands here, the U.S. consumer certainly is bouncing back a lot quicker than had been anticipated. I don't want to lose the fact that we still are in very unprecedented times with regards to, on one end, you have second quarter GDP is expected to contract at a 40 to 50% annualized rate, which has never happened before. And like I mentioned earlier, you've had 40 million people file for unemployment claims. We've never seen anything remotely like that. And so you have that on one side. On the other side, again, you have the fact that you have $10 trillion that has been injected into the U.S. economy or promised by the combination of the Federal Reserve and the U.S. government. And so those are two polar opposites there. And so far, liquidity that the Fed has provided and the government is winning out. With the stock market recovery, the U.S. consumer doing better than expected. And if we continue to see positive developments in the battle against coronavirus, that's going to be very good for all parties involved. That said, we'll still keep a very close eye, because things can turn quickly, as we've seen over the last 3 or 4 months with a lot of different developments. Thank you for watching. Take care.